Made some money in crypto last year and now you're breaking into a cold sweat just thinking about the tax man? You're not the only one. The rules are genuinely confusing, the paperwork looks like a nightmare, and the fear of getting it wrong and facing a massive fine is very, very real. But what if I told you that by the end of this video, that feeling will be a thing of the past? My name is Maya Ellis, and today on the Money Blueprint, I'm going to give you the exact step-by-step guide you need to handle your UK crypto taxes for the 2025-26 tax year. We're going to make this simple and clear, no matter if you're employed, self-employed, or not working right now. Now for a quick disclaimer. This video is for educational purposes, so it isn't financial or tax advice. You should always speak with a qualified professional about your specific situation. Alright, let's get you ready. Here's what we're going to cover. First up, we're going to clear up the absolute basics. I'll explain why crypto is taxed in the first place. We'll look at what a taxable event actually is with real-world examples. And we'll get to grips with the critical difference between capital gains tax and income tax. Second, and this is the core of the video, I'll walk you through the process based on your employment status. The rules can change slightly whether you're a pay employee, a freelancer, or a student. We'll cover all three scenarios. And finally, we'll talk about the practical steps to stay on the right side of the law. This is the how-to part. We'll cover record keeping, the tax forms you need to know about, and crucially, the new reporting rules that will give HMRC unprecedented access to your data. Trust me, you need to know about this. By the end, you'll have a clear plan to confidently and correctly sort out your crypto taxes. Before we get into the how, we have to understand the what and the why. Here's the single most important thing to know. In the eyes of HMRC, cryptocurrency is not money. It's treated as property, just like stocks, shares, or a piece of art. And because it's property, anytime you dispose of it, you might have to pay tax. This brings us to the most important concept you need to understand: the taxable event. A taxable event is just a specific action that can trigger a tax bill. The main ones you need to be aware of are selling your crypto for cash, like pounds sterling. This is the obvious one. Trading one crypto for another. For example, swapping your Bitcoin for Ethereum. This is a taxable event that catches so many people out. HMRC sees this as you selling your Bitcoin and immediately buying Ethereum. Using your crypto to pay for things. Buying a coffee or a laptop with crypto is a disposal, making it a taxable event. Gifting crypto to someone, unless it's to your spouse or civil partner, which is usually exempt. Notice what isn't on that list. Just buying crypto with pounds and holding it. You don't pay tax for just holding your assets. Tax is only triggered when you dispose of them. So what tax do you actually pay? This is where things split into two main types: capital gains tax and income tax. Capital gains tax, CGT, is the tax you pay on the profit you make when you dispose of your crypto. You take the value when you sold it and subtract the value when you first bought it. That difference is your capital gain. For the 2025-26 tax year, everyone gets a capital gains tax allowance of £3,000. This means your first £3,000 of profit is completely tax-free. But any profit above that £3,000 is taxable. This allowance has been slashed in recent years, which means a lot more people are now getting dragged into the tax net. Income tax, on the other hand, applies when you earn cryptocurrency. This isn't from an investment you sell, this is crypto you receive as payment. This includes things like getting paid for a job or services in crypto mining rewards, certain staking rewards and airdrops. This crypto income gets added to your other earnings for the year and is taxed at your usual income tax rates after your £12,570 personal allowance is used up. Okay, now that you've got the basics down, let's make this personal. How you report your tax depends on your overall financial picture, so let's break it down by your job status. If you are employed on the payee, if you have a regular job where your tax is deducted automatically, your crypto tax is handled completely separately from your salary. Your employer deals with your income tax, but they don't know anything about your crypto gains. That part is all on you. Your main concern here will be capital gains tax. The key thing to know is that the rate of CGT you pay depends on your salary. To figure it out, you add your taxable crypto gain, the amount over the £3,000 allowance, to your salary. If that total figure still falls within the basic rate income tax band, you'll pay 18% CGT on your gain. But if it pushes you into the higher rate band, you'll pay 24% CGT on that entire gain. For example, say your salary is £40,000 and you have a taxable crypto gain of £5,000. Add them together and you get £45,000. That's still in the basic rate band, so you'd pay 18% tax on that £5,000 gain. If you are self-employed or a freelancer, you might have two things to think about. First, if you're just investing in crypto personally, the same as an employee would, any profit you make over the £3,000 allowance is subject to capital gains tax. The rules are the same. Your total profit for the year from your business determines whether you pay CGT at 18% or 24%. However, if you get paid for your services in crypto, that's a different story. This isn't a capital gain, it's business income. You have to record the pound sterling value of the crypto on the day you received it and declare it as part of your turnover on your tax return. This is then subject to income tax and national insurance, just like any other payment. You may be able to use the £1,000 tax-free trading allowance against this. If you are unemployed, a student, or on a low income. It's a common myth that if you don't have a job, you don't have to worry about tax. That's totally wrong. The tax rules apply to the activity, not your employment status. The good news is that you get to use your tax-free allowances. If you earn crypto from something like staking, you can earn up to the personal allowance of £12,570 before any income tax is due. For capital gains, you still have that £3,000 allowance. This means you can make up to £3,000 of pure profit from selling your crypto investments in a tax year without paying a penny. You only need to file a tax return if your profits go above this amount. Staying compliant and avoiding fine, this part is arguably the most important. Understanding the theory is one thing, but practical compliance is what keeps you out of trouble with HMRC. Rule number 1, record keeping is everything. If you take only one thing away from this video, let it be this. You are legally required to keep detailed records of every single crypto transaction. For each one, you need to log the type of crypto, the date of the transaction, what you did, buy, sell, trade, spend, the number of units, the value in pound sterling at the time. You have to keep these records for at least 5 years after you file your tax return. It sounds like a lot because it is. Tracking this manually in a spreadsheet is possible, but it can get out of hand fast. This is why most people use dedicated crypto tax software that connects to exchanges and wallets to do the heavy lifting for you. Rule number 2, know when you need to file a tax return. You have to register for self-assessment and file a tax return if in a single tax year you've either made more than £3,000 in capital gains from crypto or earned more than £1,000 in miscellaneous income from crypto, like from staking or mining. The UK tax year runs from April 6th to April 5th. The deadline to file online and pay any tax you owe is January 31st of the next year. You'll use the main SA100 form and fill out the SA108 supplementary pages to declare your capital gains. What if you made a loss? You should still report it. If you have capital losses, you can use them to cancel out any capital gains you have in the same year. If your losses are bigger than your gains, you can carry the unused losses forward to reduce your tax bill in future years. But you can only use them if you've told HMRC about them, so don't throw away a potential tax break. Rule number 3, the future is here. CARF is coming. This is the single biggest change to crypto tax in years. The UK is bringing in the Crypto Asset Reporting Framework, or CARF. From January 1st, 2026, crypto exchanges in the UK will be legally required to collect and automatically share user and transaction data directly with HMRC. Let me be clear about what this means. The days of hoping HMRC won't find out about your crypto are over. They will have the data. This makes accurate reporting not just a good idea, but an absolute necessity to avoid serious penalties, which can range from fines of up to 200% of the tax owed to, in serious cases, criminal prosecution. I know that was a lot of information, so let's do a quick recap of the must-know points. First, crypto is treated as property, so your profits are taxable when you sell, swap, or spend it. Second, the capital gains tax allowance for 2025-26 is only £3,000. Far more people will have to pay tax than before. Third, keeping excellent records is non-negotiable. Track every single transaction. Use software to make your life easier. And fourth, with the new CARF rules on the way, HMRC's oversight is about to get much stronger. Compliance is not optional. If this guide has helped clear things up, Do me a huge favor and hit that like button. It really helps the channel reach more people who need this information. And for more simple guides on managing your money and taxes, make sure you subscribe and turn on notifications so you don't miss out. If your situation is complicated, maybe you're into DeFi, NFTs, or have tons of trades, or you just want the peace of mind of having a professional check your numbers, I always recommend speaking to a qualified crypto-savvy accountant. Finally, please remember this information is for educational purposes only, based on UK tax rules for the 2025-26 tax year. It is not financial, legal, or tax advice. You should always talk to a qualified professional for advice that's tailored to you. Thanks for watching. My name is Maya Ellis, and you have been watching The Money Blueprint. See you in the next video.